Well, it is 9:01. I think we can probably start. Mark, did you want to provide any sort of introduction, or would you like me to just go ahead and launch?
Yeah, I will. Welcome to the continuing Act 185 issue. Today we've got some ideas, and we're going to lay out how things could work if entities choose to engage in 185. Would encourage people to click on the bottom Q&A and ask any questions along the way. If it's timely and we can answer it right at that moment, we will. Otherwise, we'll try to get to all of the questions at the end. So with that, Andy Phillips, take it away.
Thank you, Mark, and good morning, everybody. What I wanted to do is, you see on the screen, for those of you who are participating in the webinar, you see on the screen a rough outline agenda here for what we're going to talk about. I'd like to start with an overview of Act 185, at least as it relates to the property tax implications, talk about what it does and what it does not do, and then try to address some high-level questions that have arisen regarding implementation of Act 185. And then we'll get into trying to understand what counties and other taxing districts, cities, villages, and towns, what they're doing in relation to Act 185, if there's interest in providing the waiver that 185 allows. And then wrap up with a discussion of the cash flow issues that are presented if the waiver occurs, and what some of the solutions are that the Counties Association has been working very, very hard on providing to the counties. So with that, we'll start with an overview of Act 185. In simple terms, Act 185 authorizes the waiver of interest and penalty on property tax installment payments that are due on or after April 1, 2020. And I want to make clear that it authorizes, it doesn't mandate, it's a choice. And the choice is held by both counties and municipalities within those counties. Act 185 contemplates a two-step process for implementation of the waiver. Step one is that the county has to adopt an enabling resolution that essentially authorizes the taxing districts, the taxation districts, the city, village, or town, to grant the waiver to a property taxpayer. Within that resolution, there has to be a recognition of the hardship and the criteria that would be applied in establishing the waiver. Now, Act 185 authorizes either a case-by-case or a general waiver. In other words, the county resolution can state that all properties within a county are eligible for this waiver of interest and penalty, or the county resolution can simply state that here are the criteria for case-by-case individual hardship determinations, and it's up to the city, village, or town to apply that criteria and determine if an individual property, and it can be a business property, it can be an individual's property, if that property qualifies for the waiver of interest and penalty. As we've indicated in previous discussions on this topic, the Counties Association, the League, the Towns Association, and Counsel for those entities is strongly urging counties to authorize a general waiver as opposed to a case-specific waiver. Reason being is that there are a lot of challenges and potential issues with a case-by-case waiver, not to say those can't be overcome, and not to say that the law doesn't allow a case-by-case waiver. It does, but there are some challenges and issues administratively and legally with a case-by-case determination. And so we think it's a better practice and better approach to authorize a general waiver if a waiver is going to be authorized. So once we have the county resolution, and I'll note that the Counties Association has published a template resolution for review. It's at the Counties Association website, wicounties.org. You can download that resolution and then customize it for what you want to see in your county. Once the county adopts that resolution, then it's up to the taxing district, the city, village, or town to adopt a similar resolution. And what we have seen from the League and the Towns Association is that they would contemplate a resolution by a city, village, or town where essentially the resolution would incorporate by reference the county resolution. And so again, county resolution in place, city, village, or town takes action on their resolution. Only upon completion of that two-step process is a city, village, or town authorized to grant a waiver of interest and penalties to a property taxpayer to allow the taxpayer to defer payment on any installment until October 1st of 2020. Now, one of the points that I wanted to clarify here is that, as most of you I think are aware, that there are different installment due dates for different municipal entities within a county. The statutory installment due dates are January 31st and July 31st. In the absence of any sort of municipal action creating a different installment process, the statute says that half of the bill is due on January 31st and the other half is due on July 31st. So that's the standard. But municipalities have, in certain circumstances, adopted different installment schedules. Some of them have adopted installment schedules where we have a payment that's due, for example, today, April 30th. Under Act 185, any installment payment that is due on or after April 1st is eligible for this waiver of interest and penalty. And so we've had questions from counties saying, well, we need to act quickly if we're going to allow this Act 185 waiver to occur, because we have certain municipalities where their installment payments are due on April 30th. And if we don't act before April 30th, well, then we lose out on the ability for cities, villages, and towns to grant this waiver in the county. And that's not true. And it may be true for the April 30 installment payment. And so in other words, if the resolutions are not in place by today, property taxpayer may not be able to defer that April 30th payment until October 1st. But you could still pass a resolution next week, and property taxpayer could then defer all future installment payments until October 1st. Let me make clear that the counties association, the league, the towns, nobody's taking a position on whether the county or the municipalities ought to grant the waiver. That's entirely up to you as to what you want to do. We're simply providing the best practices and our thoughts and the legalities and things like that in the event that you decide to grant that waiver. So again, I just wanted to clear up a bit of that misconception out there about the timing associated with this, is that a county and municipalities still have time to act to the extent you want to grant a property taxpayer a waiver until October 1st for installment payments that are due after today. Now, there's a lot more depth and a lot more questions that are associated with Act 185, and today's discussion is not meant to get into the weeds of that analysis. But I'll tell you that the Counties Association has produced some comprehensive FAQ or Q&A type questions and answers format analysis as it relates to the particularities associated with Act 185. The Counties Association worked a lot with the County Treasurers Association in developing those questions and answers and developing some of these best practices and interpretations and common thoughts as it relates to Act 185 implementation. So go to wicounties.org and you can see there are 2 Q&A sheets that WCA has produced. Take a look at those. If you still have questions after you look at those, feel free to reach out to the association and we'll do what we can to get you the information that we have regarding Act 185 implementation. I'll also note that in what I think has been a monumental effort, there has been coordination with the League and the Towns Association and also the Department of Revenue to make sure that there's consistency in the interpretation and implementation of Act 185. As far as I know, there is consistency there, and we worked very hard at making sure that there was consistency. So what you're seeing through those Q&A pieces at WCA is not only thoughts from the association, but also thoughts from the League, from the Towns Association, from county treasurers, and from DOR. And we think it's a good product, so feel free to lean on that, take a look at that. And again, if you have questions, let us know. Now, we've talked a little bit about the waiver of interest and penalties for the property taxpayer as it relates to Act 185. Let's talk about this settlement process and what Act 185 does to the settlement process. Under current law, 74.29 of the statutes, we all know that on August 20th, the county is required to settle on all amounts due the underlying taxing jurisdictions according to the tax roll. Taxing jurisdictions means city, village, town, tech college, school district, anybody who's authorized to issue a tax. It all gets rolled up into the tax roll. The county takes that tax roll on August 20th and then pays out all amounts that are shown as due on that tax roll to all of the underlying taxing jurisdictions. And so what happens on August 20th is essentially the county takes the risk of collection and pays out all amounts on the tax roll. In a typical year, for example, last year, that risk isn't tremendously great because we have a high rate of collections on property tax. This year, it's going to be more of a challenge as it relates to the collection risk. So what the legislature did in Act 185 is said, look, we're authorizing the deferral of interest, and we're authorizing the deferral of installment payments to October 1st. And we're waiving interest and penalties so property taxpayers are given a break. Counties on August 20th, if you adopted a resolution authorizing that waiver, you don't have to settle in full with the underlying taxing jurisdictions. Your August 20th settlement can be based upon money actually received by you as the county by July 31st. And so what that does is it allows the county to settle on only the money that it has received. And then that money that's actually received gets distributed proportionally to the underlying taxing jurisdictions based upon the payments. And so, for example, if we have a school district within the county who has received or property taxpayer within the school district boundaries has paid 92% of what is owed, county would settle at 92% with that school district, and so on, and down the line with every taxing jurisdiction. So that's an issue. And the reason that is an issue is because the underlying taxing jurisdictions are historically have relied on the August 20 full settlement date for their cash flow needs. And so it's our impression and understanding that many, many school districts out there have engaged in some short-term cash flow borrowing with an eye toward that August 20 settlement in full as giving the district the cash necessary to essentially buy out or refund or refinance that particular cash flow borrowing that the school district has engaged in. So this shift from an August 20 settlement in full to an August 20 settlement based upon money actually received by July 31st gives a break to counties, and that's great, but it creates cash flow issues for the underlying taxing jurisdictions. Now, when the legislature changed the August 20 settlement from a full settlement to a settlement based upon funds received, it bumped out the full settlement date to September 20th. Again, it's a month delay and it's a month break for counties, but it doesn't solve the problem. It doesn't solve the problem because if the county has already authorized waiver of interest and penalties for property taxpayers on installment payments and authorized that waiver to October 1st, looking at the calendar, September 20th comes before October 1st. And so counties are still going to be forced to fully settle on the tax roll to all of the underlying taxing jurisdictions without knowing how much money is going to come in on October 1st. So you've got approximately 2 weeks there of cash flow that the county is going to have to make up and bridge between the date that it has to fully settle and the date when taxes are actually due. And in addition, we don't know exactly how much money is going to come in the door on October 1st. We don't know how many property taxpayers are going to be delinquent. And that's a great question. It's a great question simply because nobody, I think, has a real understanding of what the collection rate is going to be. We being the Counties Association, Treasurers Association, others, have taken a look back to 2008, 2009 timeframe as a guide to figure out what the collection rate was back during the Great Recession and try to extrapolate from there what we think the collection rate might be in today's world. And we think it might be between 85 and 90%, but in reality, we're guessing a little bit because we really don't know what the impact of the COVID-19 crisis is going to be on property tax collections. So the reason I'm highlighting this is because if we had a 2-week cash flow issue that we had to bridge between September 20 and October 1st, I think that's manageable. And I say that I understand and that I'm not in charge of managing it, so it's easy for me to say it's manageable. But we think it's manageable because we have fund balance that could be applied to float, so to speak, that 2-week gap and otherwise bridge between when we have to pay out on the settlement and when we're going to collect the taxes. But the cash flow issue could extend far longer than October 1st, because we may get to October 1st and have a lot of property taxpayers who are unable or unwilling to pay their bill at that point in time. And so the cash flow issue may extend beyond October 1st. So I guess to sum all of this up, the Act 185 cash flow problems, we've got basically two categories of problems. Number one, we've got the August 20 problem with our school districts, cities, villages, towns, and other taxation districts, jurisdictions that are within a county. We've got the August 20 problem. And then we've got the September 20 problem, which is a county problem as it relates to cash flow. And so in looking at some of the potential solutions for these cash flow issues, the Counties Association has been in extensive discussions with the State Treasurer's Office, the Board of Commissioners of Public Lands, finance professionals, others here local to Wisconsin, to try to figure out what are opportunities to try to solve these two very acute and problematic issues that Act 185 presents. And so I want to give you an overview of some of the solutions that we've explored and had discussions with others about, and then talk about, well, answer any questions, but then talk about what perhaps the interest level is out there for counties on pursuing some of these options. So first, I mentioned the State Treasurer's Office and the Board of Commissioners of Public Lands. They're very eager to help. They want to provide a solution, and they want to try to assist counties and other taxing jurisdictions with these two cash flow issues. The problem, and it's not so much of a problem, but it's a bit of a problem, is that they are constrained, the Treasurer's Office and BCPL are constrained by state statute and other regulations as to how much interest they can charge on this short-term borrowing. And so sometimes the rate, while oftentimes attractive, is not always the best rate that can be obtained through market means on this debt that would be issued by a county or an underlying taxing jurisdiction. BCPL understands this. And I think that we've seen from BCPL and the Treasurer's Office a desire to participate in whatever financing mechanism a county or an underlying taxing jurisdiction comes up with. What do I mean by that? I mean that if we end up issuing bonds or if we end up issuing notes, then BCPL has indicated we would be interested in taking a look at purchasing some of those bonds or some of those notes as a way to help out local governments in Wisconsin bridge these two significant cash flow problems. The second option that we've been exploring and looking at is, from a county perspective, shifting some of the capital projects that are currently paid for with operational revenue. In other words, it's paid out of general fund and it's based upon the property tax levy and sales tax revenues that are coming in. We pay as we go and we fund these capital projects. What if we shift some of those capital projects over to debt, and we issue general obligation bonds to fund those projects, thus freeing up cash for operations? As all of you, I would assume, know, the debt service associated with a general obligation bond issue is not counted within the levy limit. So in theory, it frees up space under the levy limit to devote more resources toward operational costs. There are statutory requirements associated with issuing general obligation debt and other requirements. You have to have among other things, you have to have a 3/4 vote of the county board in order to authorize and issue the bonds and this general obligation debt. So there are some procedural hoops to jump through there, and frankly don't know what the appetite would be for counties to have a large-scale shift of resources from the operational side of the budget over to the capital side of the budget. So the third avenue that the Counties Association has explored in some pretty great detail is the concept of issuing revenue anticipation notes. The concept of revenue anticipation notes is not foreign to school districts whatsoever. Before I mentioned this whole concept of school districts issuing short-term borrowing notes and engaging in short-term borrowing, counting on that August 20 settlement date. And so what school districts have historically done is issued revenue anticipation notes, saying essentially to the market, let me borrow money from you understanding and knowing that on August 20th, we're going to receive our full settlement of property tax payments due us, and we will pay you back at that point in time. So school districts have historically engaged in quite a bit of revenue anticipation note borrowing. Counties have not historically engaged as much revenue anticipation note borrowing, and counties haven't needed to like school districts. Not saying counties have never done this, counties have done this, but it's just not as common as with school districts. Nonetheless, if you look at Chapter 67 of the statutes, which is the chapter governing municipal and school district borrowing, counties are authorized under 67.12 sub 1 to engage in this revenue anticipation note borrowing. There are a couple of conditions associated with this. First, counties can borrow up to 60% of the revenue that is anticipated in a fiscal year. In this case, we're talking about property tax revenue. And so counties, the limit on borrowing is 60% of what the county has actually received or anticipates receiving of tax revenue for the year 2020. Second, if the county borrows money in anticipation of these tax revenues, that money has to be paid back within 18 months of the start of the fiscal year in which the money is borrowed. So that means that if the county were to borrow tomorrow based upon anticipation of property tax revenues up to the 60% threshold, then the county would have to pay that money back by June 30 of 2021. The procedural requirements associated with general obligation debt for counties are not there. What do I mean by that? Well, we know that in order to issue general obligation bonds, we have to have a resolution adopted by the county board by 3/4 vote of the county board. That requirement isn't there for these revenue anticipation notes. So essentially, what happens is the county, by simple majority vote, can authorize the issuance of these revenue anticipation notes. So when we talk about this concept of revenue anticipation notes, it's obviously a vehicle that counties can use singularly to go out to market and sell their notes, probably get a favorable interest rate because those notes are going to be backed by the anticipated property tax revenue. So counties can likely get a pretty decent rate on that. But we at the association started thinking about how to pool these notes together to drive the costs associated with this borrowing down, because we recognize and understand that counties, number one, were strapped for additional funds heading into this COVID-19 crisis, and we certainly are taking a big hit as a result of COVID-19 because of the loss of sales tax revenues, other revenue streams, and in addition, a potential for a huge problem associated with property tax collection. So we want to try to make this as low cost as possible. So what the association did in talking with some finance professionals is indicated, what if we pool these notes and then issue bonds to back those notes? Can we drive the interest rate down? And the answer has been yes. If we pool those notes and issue bonds, you can drive that interest rate down. So the Counties Association reached out to its partner organization, the Public Finance Authority. And the Public Finance Authority was created in 2010 by cities and counties here in Wisconsin, and it's sponsored by the League of Wisconsin Municipalities, the Counties Association, National Association of Counties, National Association of Cities. And essentially what PFA does is it's a conduit issuer, and it issues debt to allow projects, economic development projects, to get to the bond market on a tax-exempt basis, or in certain circumstances, a taxable basis, to essentially help promote economic development at the local level. So PFA started talking with the Counties Association and started talking about the ability for PFA to issue bonds that essentially would, that are backed by these revenue anticipation notes that would be issued by counties on a pool basis. So that instead of having, for example, a $1 million note go out to market, we would have a $50 million or $100 million or $150 million collaboration of these notes going out to market, thus driving the interest rate much lower. And so PFA indicated, yes, this is a project that is very worthwhile, and we're very interested in discussing this further, but we should talk with an underwriter or a finance professional to find out what is the market that's out there and what kind of rates are we looking at. And so PFA went to one of its Wisconsin-based underwriters, BC Ziegler and Company, and talked with Ziegler, with whom PFA has done a lot of business with. and talked to Ziegler about this program. And Ziegler has run anticipation note programs throughout the country. So it's very familiar with this process, understands the market, and understands market opportunity. And so Ziegler started crunching some numbers and taking a look at the opportunity and taking a look at the ability to essentially bring all of this anticipation note debt together and issue bonds. And they came out and indicated that we're looking at an interest rate of about 1.5% inclusive of costs associated with the borrowing. And again, that could fluctuate depending upon market and depending upon various costs and things like that. But I know we've got a commitment from the Counties Association and PFA to do as much as they can to keep those costs to a minimum. So again, at 1.5%, it's not a guarantee or anything, but that's essentially kind of what we're looking at for a rate here associated with that borrowing. That 1.5%, at least based on what I've reviewed, and I think what the Counties Association reviewed, appears to be a pretty attractive rate that's out there. And so at 1.5%, we'd have the ability to coordinate all of this anticipation note type debt and put it together and go out to market. And then counties individually would have to, pay on their notes by June 30th, 2021. And the bonds that PFA would issue would be secured by the revenue streams anticipated from those notes. So that's kind of an overview of what we're looking at on the various financing options that are out there and available for counties. And I think, a couple of questions that emanate from that. Number one, we've had discussions and thoughts and analysis and research as to whether the costs associated with borrowing by counties could be recouped through the CARES Act funding that we've had. We've already had one appropriation coming from the federal government down to Wisconsin, and it's to be distributed to local governments and others throughout Wisconsin. Can we claim these interest costs as costs associated with the COVID-19 crisis such that we could get reimbursement for those interest costs? I will tell you right now, it's not looking likely. Based upon my initial review, I don't know that we can do that, but we are going to work our tails off to figure out a way to fit this within the definition that the Treasury Department at the federal level, what Treasury has indicated as acceptable uses for this CARES Act funding. So we're not done with the analysis. We haven't reached an ultimate conclusion there. We're still going to work on it, but I wanted to let everybody know, don't hang your hat on this because it's not looking like it's a guarantee at this point. So we're going to keep researching those options. The other thing that we don't have a good handle on is whether the waiver of interest and penalties is going to be widespread. In other words, out of the 72 counties, are there going to be 60 counties that authorize the waiver? Are there going to be 5 counties that authorize the waiver? We don't know exactly how many counties are going to authorize the waiver. Likewise, we don't know how many counties would be interested in fully settling with their taxing jurisdictions on August 20th. Remember when I talked about this deferral of the full settlement from August 20 to September 20, Act 185 authorizes that deferral, but it doesn't mandate it. In other words, if a county decides, look, I'm not going to create cash flow issues for my school districts within the county by delaying that full settlement date, I want to fully settle on August 20, and I as a county, because I'm a good Samaritan, I'm deciding to take on all of the cash flow issues that result from the full settlement on August 20, a county can make that decision. A county can do that. And we've talked with some counties who are looking at that option. We just don't know how many counties are in that same boat. In other words, are we going to have 60 counties that fully settle on August 20, or are we going to have 5 counties that settle in full on August 20? Just don't know. The reason that we are interested in finding this out is that it obviously drives some of the discussions that the association is having about these different financing options. The more money, obviously, that is available in a pool to be securitized by a bond issue, typically the lower interest rate you're going to get. You have some efficiencies created by volume. And so the more volume that can be within the program, the lower that effective interest rate can be. And so purpose of today besides providing information and talking about some of these options, part of the purpose today is to try to gauge interest of all of the attendees on here. What are the options that we're looking at? What other information can the association provide to you to help you weigh those options? What options may be out there that the association has not yet investigated that might be worthwhile in terms of taking a look at? And otherwise, just engage in a little bit of back and forth to have an understanding of where we're going with the entire program. So with that, why don't I turn this back, Mark, if you wanted to provide any sort of wrap up or overview on that, and then we can start going down some of the questions that we've received here. So Mark, did you want to add anything to the discussion thus far?
Yeah, the issue of generating a fund or dollars available to bridge that gap of settlement and when dollars will come in, as Andy indicated, it's certainly going to be 10 days, 11 days, but more likely much longer than that. What we're looking at with Ziegler and our other finance professionals is how we engage so we properly take care of any arbitrage issues so that the dollars are available as a group issue, but individually in terms of taking advantage of each individual county's bond rating. I think this really can work, but I'm really interested to hear if there are other ideas that our experts on the call want us to investigate. It's certainly by no means the only answer, and there may be better ones out there. So we're interested in any thoughts or suggestions or directions you'd like us to go investigate, and we'll go do that. I think we have several questions, Andy, and that we can move to those here in a moment. Mm-hmm. Part of the challenge is going to be deciding county by county if you're going to go forward with this 185 permissible activity, and then secondarily an approximation of how many dollars you might need if you're going to participate in a group sort of issue to generate dollars to take care of the bridge. Let's call it bridge financing, for lack of a better term. We would need to know that probably sometime in July to have the process run smoothly. So there are timing issues. The language of 185 is not perfect. It certainly is causing us some consternation. The dates don't line up quite right. It's not probably how anyone on the call would have written the language if you were writing it, but it was done rather hastily. But we will work with it if counties and municipalities choose to engage in the 185 permissible activity. So with that, Andy, why don't we move to the questions? And
sure.
Anne-Marie, if you want to read those questions for everyone's ease of understanding what the question is, and Andy, you can take it.
Sure. So we have a question here from Lori, and she's asking, is there a penalty or cost for paying the revised anticipation note earlier than June 30th, 2021?
And so a revenue anticipation note is no different than any other financing instrument in that there are negotiated terms associated with those notes. Oftentimes when you issue general obligation bonds, there's a no-call period where you don't have the ability to pay those bonds off early because investors are anticipating and relying upon a certain return. And if you do pay it early, there may be a prepayment penalty, so to speak. Those terms are negotiated. We anticipate that there would probably be a negotiation about some sort of prepayment penalty and a no prepayment period, whatever the case may be. We haven't gotten that far into the process to make a determination of exactly what these notes would look like. And again, it depends upon the negotiation associated with those notes. I can tell you that, at least from my perspective, I would want to make it as flexible as possible for counties so that if the cash is there, they're not forced to pay interest. The one thing that's a bit attractive about these is that given the low interest rate, they're, especially if you go to market on a taxable basis. In other words, you're not issuing tax exempt paper. If you go to market on a taxable basis, you don't have the arbitrage concerns. And so if you can generate investment returns above the interest rate, that's an acceptable use. And of course, there are some technical things and some peculiarities that we're going to have to pay attention to and work through. But just on a very high level basis, there should be a way to make sure that the county is not forced to pay interest and go in its pocket when it otherwise has the funds available to pay off the debt. And we're still looking at those issues.
We have another question, and before I do that, just a reminder, if you're on the phone, press *9 and it will indicate that you have a question and I will unmute you. The next question, Christy is asking, the 60% of property tax revenue for anticipation notes could be on the total 2020 property tax, not just the GAAP amount not collected by August 20?
That's right. And this, the reason I'm hesitating is that there are rules under Wisconsin law, 67.12 sub 1, that relate to the 60% threshold on how much can be borrowed by a county. There are also federal tax rules where if you're going to issue tax exempt debt, there are rules associated with how much can be borrowed, again, for purposes of this financing and making sure that it qualifies for a tax exemption. So I want to talk just briefly about the Wisconsin rule, because the federal rule, it's a bit complicated and I don't want to get into that level of detail. So from a Wisconsin statute basis, 67.12 sub 1 authorizes a county to borrow up to 60% of actual and anticipated revenue stream. And it's not just taxes. And that's another issue that we're exploring here. If the feds, for example, were to authorize additional payments that come direct to counties later in 2020, let's say that the feds authorize $1 million per county to come in October and November of 2020, you could issue a revenue anticipation note based upon that $1 million that's coming from the feds. So again, it's up to 60% of those revenue amounts, both actual received already and anticipated within the current year.
Okay, one more question. How soon would you need to know how much we need to borrow? Who do we contact with the amounts needed? And can the payments be paid off earlier than June 30th of 21?
Yeah, and I think I answered already the June 30, 2021 question, talking about the negotiation associated with prepayment and whatnot. And we have a rough timeline, and again, this isn't finalized, and I'd be interested in Mark's thoughts about process here, where we go from here. But when we talk about the timeline, I think in June, we need to start looking at what the loan program documents look like, because I think that based upon feedback we've received from Ziegler, and I think it would be Ziegler's preference to get rating agencies to review this, because rated debt is going to generate a better return in terms of interest rates in the counties than non-rated. So we need to have some documents and other information gathered for purposes of asking ratings agencies to take a look at this. That's in June. Then by early July, and that's what Mark was talking about earlier, by early July, we want to have a final understanding of exactly what counties are participating and how much those counties are going to borrow. So I think between now and early July, we have to have a process for establishing initial thoughts on amounts, because that's going to drive interest rate. We need to have an understanding what counties want to borrow, because if we're going with rated debt, the rating is going to be based upon all of the counties' underlying credit rating. And so not every county has a credit rating that's the same throughout the state. So having an understanding of what counties are participating in the program is going to help tremendously in understanding, again, what the costs associated with the program are going to be. So between now and early July, we have to have a process that gets us to the point of having an understanding, just notionally, of who's going to participate in this type of program. But we need to have the final amounts by early July, because it would be our thought that throughout then, once in early July, we know exactly who's going to participate. Then we're going to go through the process of pricing those bonds throughout July, and then we're going to sell them in mid-August to make sure that those funds are available for August 20 when the counties need those funds. And so that's, again, a very rough calendar associated with this, and I'd be interested in Mark's thoughts about how we try to coordinate the process between now and early July in terms of gauging interest and participation.
Well, and thanks, Andy. Let's assume for a moment that we coalesce around this particular idea to engage in a financing mechanism where we pool and issue one larger debt instrument with individual obligations by the counties. Let's assume for a moment that's the route we go. Obviously, the earlier the better, and many people on the call have engaged in a debt financing operation before. Yet there's a balance. I mean, you won't actually know what it is you need until you actually have a settlement date. So what do we have to go on? Well, history, except we really have no history in regard to this kind of a challenge that we're facing right now. So it's going to be our best educated guess, county by county. How we might go about that? Well, as soon as we can, I guess, firm up this particular option, if in fact that is the option we coalesce around, then we're going to be contacting probably every county one by one to ask if number one, if you've engaged in the activity permitted by Act 185, and number two, if you are interested in this financing option, and then three, what dollar amount or estimate might you be interested in. If we can navigate the prepayment issue, then it eliminates, I think, a lot of potential, even though it'd be minimal, potential risk. In other words, if you think you're going to need $10 and we have a very low interest rate, let's say 1.5, but there's no prepayment, or at least no prepayment until after, let's say, 3 or 4 or 5, 6 months, then you might need $10 or estimate you need $10, but you might issue a note or take responsibility for a portion of the note at, let's say, $11 or $12. And then if not necessary, if not needed, when things shake out on October 1, then you engage in the minimal prepayment penalty or no prepayment penalty after 4, 5, 6 months, and then take the extra $2, pay it. So we'll have to work out those kinds of details. It's not perfect. I would love for the CARES Act or any future dollars that the federal government might be coming up with in a fourth state and local government package to have language which indicates that costs related to financing are eligible reimbursable costs for any dollar amounts that we might be getting from the state, or if we can change the language or create language which changes the eligibility for CARES Act money to make the costs of interest an eligible expense for reimbursement, that would be ideal as well. And that pretty much eliminates the interest or dollar amount risk for individual counties. But we're not there yet. So a lot of work has to get done between now and the end of June so that we can be in a position, if again, this is what we coalesce around, so we can ask you in July what dollar amount you might be interested in. So we've got this. We're in the early stages, but we will lay it out as an association if we move in this direction to make it as easy as possible. Understanding, of course, that this is new for everyone. I mean, no note like this has been not even the note in the 90s that many of us engaged in to pay off our unfunded liability with the retirement system was actually quite as complex as this. So it's new territory. But I do think there is an avenue where the association can play some sort of an assistance role to allow counties and municipalities to do what it is they wish to do in Act 185. Kyle, did you have anything to add to anything we've talked about here?
Thanks, Mark. I guess just two quick items. One, within the Q&A, we did try to answer some of the questions in there. So make sure you take a look at those. But the second piece that I think is important to remember, and sometimes when we discuss this from the county perspective, I think it gets a little confusing, but the county's ability under Act 185 is simply to pass a resolution authorizing essentially municipalities to waive their interest payments. So in the event the county passes a resolution saying we're going to allow for the waiving of interest and penalties until October 1st, the due date for all taxpayers still remains July 31st unless a municipality passes a similar resolution to the county. So it's just important to remember that there's this two-step process and really nothing changes for individual taxpayers. unless the municipality follows suit after the county takes action.
All right, Andy, we have two more questions here. Would it be possible or reasonable, instead of doing this resolution to help taxpayers, for a county to set up a revolving loan fund to pay taxes, maybe in coordination with another entity to administer it, to try to still help but limit our potential financial liability to those who truly need assistance?
That's a great question. I have been talking with several counties out there who are looking at different opportunities to provide essentially economic assistance to a lot of folks that are hurting out there. I've heard ideas floated about helping out local chambers of commerce or business organizations or economic development associations, other 501c3 nonprofits to try to provide relief to taxpayers and citizens. The answer is a bit complicated. And it's complicated because we as counties are constrained by statute, primarily Chapter 59, in terms of what it is that we can and cannot do. Some of you may recall that a few years ago, there was an Attorney General's opinion that dealt with appropriation to a local food pantry and whether that was allowable for a county. And the Attorney General said under those circumstances, no, it was not. I happen to disagree with the analysis and the result there, but I think it is illustrative of the challenges that we have as counties trying to make sure that we comply with Chapter 59 as it relates to the activities in which we engage. On top of that, we have public purpose doctrine concerns in that we are taking essentially taxpayer money and devoting it to a private purpose. And we have to make sure that whatever we do in that regard satisfies public purpose doctrine analysis in addition to Chapter 59 authorization analysis. So that's a very long-winded way of saying it's possible. I'm not going to say it's not possible, but it is a bit complicated in terms of the way that that program unfolds and works, as opposed to, for example, an existing federal or state program that a county participates in. You can obviously spend money through that type of program. It's been specifically authorized. If we're talking about creation of a new program, it presents some challenges.
All right, and then Kyle answered the last question in the Q&A panel. And just a note to everyone, also in the chat panel, Michelle was texting some resources for you. So just a reminder that we do have a website up, and it is covid19.wicounties.org. And at that website, you will find all COVID-19 related news and documents, some of which were discussed on this webinar. That's all I have, Andy.
Okay, so we have a couple of minutes left before we reach 10 o'clock. And so let's just leave it open for a couple of minutes and see if any other questions pop up on the screen.
Yeah, questions or ideas on other directions that you might want us to look into, or even if you are a county and you know whether you are or are not going to engage in the Act 185 resolution process, let us know that too. That'd be great for us to know.
And if you're on the phone, *9, and I will unmute you.
One thing we did learn in this process is that if we're going to take any action as a state in modifying tax collections and the process related thereto, it really should be written by treasurers and finance directors, because those are the folks that actually know how this works.
Mark, along those lines, I think it was Kyle who indicated that he really enjoys when legislative language is drafted on midnight the day before it is actually introduced and passed. I think Kyle said how much he appreciated that.
You know, and I'm not criticizing the legislature. They were incredibly well-intentioned. They wanted to give people a break, but when you rush language and get it, you know, drafting it in the last minute, then it may not be the cleanest. So other thoughts, suggestions, directions you'd like us to look into, actions that you know your county or is going to take or might contemplate taking? We've got Still got about 140 plus people on the call. I'm not seeing anything. Kyle, oh wait, we have one comment here. Go ahead, Anne-Marie.
I do have a question. Do you have direction on taking tax certificates?
That's a good question, and that is addressed in the supplemental question and answer paper that the Counties Association put together with the County Treasurers Association. Act 185 did nothing with the tax certificate process, and so even though Act 185 allows for a waiver of interest and penalties until October 1st, it does not change the status of a particular property being delinquent if that property has not paid the taxes when otherwise due. And so on September 1st, that's the statutory date for issuing the tax certificate. On September 1st, there will be properties that appear on the tax certificate where the property taxpayer otherwise is given a waiver of interest and penalties until October 1st. And so this is an example of when Mark talked about finance professionals and treasurers working with the law. The legislature was focused on installment payments and good intentions to give folks a break on that. But again, the unintended consequence is that we have a September 1 tax certificate issued with parcels identified on that tax certificate where the taxes are technically delinquent. They are, and that property should appear on the tax roll, but property taxpayer is going to pay in full on October 1st. So we're going to have a process unfold this fall where we have a tax certificate issued and then changes to that tax certificate based upon receipts occurring on October 1st.
All right, and then Pam Hansen is asking, this is going out to everyone on this call, can any county that has already either passed a resolution or decided to not pass a resolution let us know? And then here's a question for you, Andy. If we pull revenue anticipation notes, will the WCA provide draft resolutions so that the county ran resolutions are uniform and provide a timetable for action by each county? This would be helpful if pursued by counties.
The answer is yes. What we anticipate happening with this program is if this is the route that we decide to take and counties express interest in pursuing this route, it will be truly programmatic in that everything will be coordinated through the Counties Association in terms of those resolutions, in terms of the timetables, in terms of the information necessary to be received from all of the counties to get to Ziegler for purposes of going to market. And so everything is going to be uniform as it relates to all of those items. So yes, WCA will be taking care of all of that.
All right, another question here. If we only receive 90% of the property tax revenue this year, do we need to cut our budget to match that cut since we have to pay out the other taxing districts? What is the long-term effects of less property taxes that we keep paying out other districts?
That's a little bit more of a practical problem, Clark, as it relates. And when I say that, I mean that, obviously the collection rate is going to be different for each and every county. And I think that counties are going to experience budgetary pressures associated with uncollected property taxes or unpaid property taxes. Counties eventually get to foreclose on property and take title to property based upon unpaid taxes. That really doesn't help counties out during that 3-year process where the county is foreclosing on the property and taking a deed. And so I think there will probably be a lot of counties that have to go through some budgetary changes as a result of unpaid taxes. If the collection rate is at 90% or even lower, I think counties are going to be faced with some cash flow issues. I think one thing I would suggest, Clark, is that reaching out to your colleagues that were engaged in this process in 2008, 2009, 2010 would be very, very helpful because counties faced similar, not the same, but similar circumstances back during the Great Recession. And I think that they would be more than happy to share with you some of the things that they did to try to weather that storm from about 10 years ago.
Yeah, Clark, this is Mark. That's a really good question. And I'm thinking if we if we only collect 90% of what we need, and there's no relief on settlement, which there isn't, whether it's 185 or under normal conditions, then we are short dollars. And at that point, we either need to take it out of our pocket if we have any in our pocket, or find some other revenue stream, or reduce our expenses, over which many times we have very little control. So it is true that we are, on our balance sheet, more or less, we are gaining an asset. Presumably the asset is worth more than the taxes owed on it, but it's a 3-year lag in turning that asset from a hard asset into cash that we can use when we need the cash 3 years earlier. So, eventually, if we have an increase in delinquencies and foreclosures, it presents a cash flow issue, but not necessarily a total dollars to the county, you might say, balance sheet issue. But it will be challenging. And in this COVID-19, while we have a 2-month COVID-19 challenge, it's going to go on way beyond that, because folks that either lost their jobs or businesses that closed and did not reopen, it's going to be difficult it's not like the economy is going to come back, all of a sudden next month. So we're going to be faced with decreased capacity to pay property taxes for lack of income or lack of a job. So I think it's a very real possibility that parts of our state are going to see a prolonged decrease in the capacity to pay taxes, or translated into an increase in delinquencies, and then probably likely foreclosures as a result, putting us in a difficult spot. I think we're going to be in that spot, and that will mean financing to take care of our current expenses, or reducing expenses. We have
All
another
right,
question,
and then,
Henry?
yeah, thank you, Yvonne. Yvonne has replied to Pam's question about resolutions, and she says Barron County did pass a resolution, and the city of Rice Lake has also passed a resolution. Rice Lake has a second installment payment due today.
And I think, Mark, correct me if I'm wrong, but I believe that Portage County has also adopted a resolution. So we've
Yes,
got.
Sandy, that just came in from Jennifer.
Okay.
So yes, Portage County has also passed a resolution.
Was
Anyone
there?
else?
I thought there was one other. I can't recall off the top of my head.
The list that I had so far, Manitowoc, either counties have or are considering passing. Manitowoc was a yes. Dunn was a no. Buffalo and Monroe were question marks. La Crosse was a yes. Outagamie was a yes. Barron is now a yes. Portage was a yes. And that's all the counties that I'm aware of right now. All right, other questions, comments, suggestions? Kyle, do you have anything else you'd like to add?
Nope. I think we covered it, Mark.
Andy, anything else you'd like to add?
No, I would just, as a final parting thought, I would really encourage counties to talk with school districts, cities, villages, and towns in the counties, and understand these cash flow issues and what some of the potential solutions might be. Have an understanding of who has borrowed what money, when, and when's it due, and really, this is an opportunity for collaboration. It's not only an opportunity, but I think it's a requirement that we collaborate with our other local government and school district partners to try to figure out solutions to this particular problem. It's complicated, it's difficult, but it's certainly not insurmountable. It can be done. So really, really encourage folks to go out and talk with your counterparts in schools, cities, villages, and towns.
After the call, if ideas or questions come to mind, please feel free to contact either Andy, Kyle, or me, and we will try to address them on an individual basis. If it is beneficial to have another group conversation, we will certainly do that. And if people have suggestions as to any other direction we might put some time, effort, and energy in terms of options for financing, let us know. Right now, we'll do some work on the potential tiered anticipation note idea and see if that is viable. But if there are other ideas, please let us know. And with that, we will close out this webinar. Thank you all for attending, and thank you for the questions. And thank you for your service to county government. Please be safe.